Welcome to the Market Mosaic, where every week we are taking a look at macroeconomic data, market technicals, as well as the stock market's internals, things like breadth and sentiment, to try to formulate a view of where the stock market could be headed over the near and intermediate term. And so let's just jump right into it. We had a huge week last week, a very pivotal moment on Friday when Federal Reserve Chair Jerome Powell at the Fed's Jackson Hole Symposium came out and surprised everyone by flagging concerns over the labor market. Noted that policy is in restrictive territory in a nod to the Fed funds rate being elevated, and noting that the shifting balance of the risks may warrant adjusting the policy stance. Again, that's a nod to weakness in payrolls. The July payrolls report coming out after the last Fed meeting, and we saw some big revisions to jobs growth in prior months as well. So those comments came just 2 days after the minutes of the Fed's most recent rate setting meeting was released. And that took place, this is what's notable, that meeting and the minutes from that meeting took place just 2 days before that weak July payrolls report came out. And now we're going to start to see the Fed really start to flip-flop around here, because in the minutes they flagged upside to inflation as the bigger risk. The majority of the voting members of the Fed's board that sets rates saw upside risk to inflation outweighing employment risk. And that's easy to see why. It's because we had a higher than expected core CPI report for the prior month. We had a very hot producer price index for the prior month. And all signs point to accelerating inflation down the road. That's what this chart on here is showing. It's showing this orange line. This is the prices paid component of a business survey. So it's asking businesses about the prices that they're paying for inputs into their products or their services. That's what this orange line tracks. This orange line, by the way, this has moved forward by about 4 months, so you can see the lead time that it has on PCE inflation. We'll come back to PCE inflation here in just a minute, but that is the Fed's preferred consumer inflation gauge. And you can see how this blue line and this orange line line up with each other. These really key inflection points, higher or lower. When you see prices paid rising, you tend to see PCE picking up. Vice versa on the downside. When you look back to the last cycle, we saw this prices paid component really jump coming out of the pandemic. Inflation followed suit. We saw it peak and come back down, as did PCE. We've had this disinflation trend, but now you can see it has started to stall out, and now it's actually moving the other way. So all signs point to accelerating inflation in the months ahead. But again, based on the data that's coming out, you could see the Fed really start to flip-flop around what they believe is more important. Now we've seen this sudden pivot, from away from inflation toward the labor market, and so that's sparking hopes that we're going to start to see rate cuts again. The Fed's been on hold with rate cuts for 8 months now. They actually started cutting last September. They surprised the market with a 0.5 percentage point cut. Those, typically you see a 1/4 point cut. Larger cuts are usually reserved for emergencies, but you saw them come out with a 0.5 point cut back in September, and they've lowered rates by 1% into the end of last year. But since December, they have not touched interest rates. They've been moving they've been sideways, holding them steady. But Powell's speech is giving some indications that you could start to see this rate cutting cycle happen once again. But there are some other key things in his speech that have gone overlooked that you have to pay attention to. Powell noted that the Fed's policy framework of something called flexible average inflation targeting, that is going to go away. In simple terms, what that means is that the Fed used to be willing to tolerate an overshoot of its 2% inflation target if that meant supporting the labor market. Again, they're abandoning that. And that's interesting to note that core consumer inflation, the core CPI, is at 3.1%. That is well above the Fed's 2% target and has been moving higher in recent months. And so there's going to be a lot of confusion in the months ahead as to whether or not the Fed's more concerned about the labor market versus if they need to pivot toward fighting inflation, especially now that they're abandoning this average inflation target. So it's right. They're basically saying that they're not going to tolerate inflation above target. Right now, inflation is above the target, but the market is focusing on the implications of falling rates. And that is igniting the risk on trade. We've already seen signs before Friday that the risk on trade was coming back. We've seen a big boost in the average stock. Well, that really took off on Friday. And so we'll look at some metrics pointing to a big rebound in the average stock. But I also want to come back to the inflation side here in just a moment and why a commodities breakout could be the next warning on the inflation outlook. First, let's just start with the fact that liquidity and overall financial conditions, they play a key role in supporting, call it, speculative area of the capital markets. That includes stocks, that includes cryptocurrencies, and so on. Liquidity and the availability and cost of credit, those are positively correlated with economic activity. When liquidity is plentiful, when credit is cheap and available, you tend to see that tends to be supportive for the economy. That tends to boost the economy. And why is that important? Well, because a strong economy, that's critical for the earnings outlook. Stocks follow earnings over the long term. So the prospect of the Fed resuming its easing cycle while conditions are already loose, that is a massive, massive tailwind for all sorts of risk assets, again, like stocks and cryptocurrencies. So the chart on here is showing financial conditions. This is a measure of financial conditions from the Fed's Chicago district. It takes into account things like volatility in the equity markets, what credit spreads are doing, things happening, strains in money markets. And it's constructed so that a reading above 0 means conditions are tighter than average. Below 0 means they're looser than average. This goes back to the start of 2020. And you can see, looser conditions tend to be correlated with rising stock prices. You had conditions loosening into late 2021 as the Fed started to tighten policy in 2022. Conditions moved back the other way. Remember that right in this time was when we had we had a bear market in stocks. Since late 2022 and into now, we've seen conditions continuing to get looser and looser still. And this turn lower in conditions, that's coincided with this bull market, this cyclical bull market that we've currently been in. So look, loose financial conditions, they're positively correlated with economic growth, and rate cuts, if we add rate cuts to that, could boost the economy at a time when I believe growth in the economy is likely way, way stronger than many fear. There's a lot of fear around that weak July payrolls report, but other estimates of economic activity are holding up. We've talked recently about the Atlanta Fed's GDP Now estimate. They show current quarter GDP running over 2% annualized. Well, the most recent evidence also came last week, and that is what the S&P Global's, their flash US PMI. That PMI, called a Purchasing Managers Index. It's built off a survey of senior executives, business executives, and these things are constructed so that a reading above 50 signals expansion, while below 50 indicates contracting activity. Well, here's the thing. Their composite PMI, so looking at manufacturing and services combined, it came in at 55.4, so above 50, right? 55.4 is consistent with 2.5% annualized GDP growth. All right. The chart below, or this chart right here, this takes and looks at the manufacturing versus services component of that PMI, services in orange, manufacturing in blue. And what you'll note is that just recently, services has been a big driver and it's been holding up pretty well. The thing to note is that manufacturing, especially this year, the manufacturing PMI is making a big comeback. We saw this dip at the start of the year around trade war and tariff headlines. Well, it looks like as some of that's clearing up, manufacturing responses in these PMI are becoming more positive again. So again, we're seeing loose financial conditions and potential rate cuts at a time when indicators point to an economy that's performing just fine here. So this combination of falling interest rates on the short end, if we see the Fed start to cut, and a positive economic outlook, that should be the perfect storm to drive outperformance in the average stock. We hear a lot about the Mag 7, names like NVIDIA, Microsoft, Apple, Tesla, so on, and how they've been such a big driver of the market over the last several years and how they've been driving the earnings picture. Well, if we want to keep this rally going, we need to see the average stock really start to kick in. Conditions are favorable for that, and we're starting to see, and we are seeing, the breadth metrics confirm. So we've had the S&P 500, we've had the NASDAQ at new record highs. Just last week, we saw the Dow Jones. So the Dow Jones is more reflective of an average stock index. The Dow Jones is making a new high. The equal weight S&P 500 ETF, the ticker is RSP, that is making a new high. So that's a good sign on the average stock. While surging breadth is also showing up in how you want in measures of advancing versus declining stocks. So on Friday, during the aftermath of Powell's Jackson Hole speech, if you look at up volume on the NYSE as a percent of all volume, is over 90%. I think if I saw someone posting correctly, they stated that this was the first time that you've ever had a 90% up volume day with the stock market at a new high. 90% up volume is typically seen around a low, when investors are rushing, especially institutional investors are rushing to get in. Now you've got 90% day at new highs. Well, in this chart on here, what this shows is the NYSE advanced decline ratio. So if you take the number of advancing stocks divided by the number of declining stocks, it creates this ratio. This is plotted daily, and you can see on Friday we had a 10-to-1 day. So 10 advancing stocks for every declining stock. It's the third highest reading of the year. The only higher instances, you got to go back to the April lows around all the tariff headlines and how that sparked that rally. I mean, look at this. I mean, you see these, call it breadth thrusts, that come into the market. It shows investors rushing to get in, and that purchasing power, that buying demand, can spark these really nice rallies like we've seen. And now we got another one kicking in. So great sign to see there from the average stock. All right, the Fed does resume the rate cutting cycle. So we're going to see what happens here in about a month. But if they do, then small caps specifically could see a big boost. And here's why. Small cap stocks relative to large caps, they get a larger share of their revenues and earnings from the domestic economy. So if the Fed's cutting rates, if conditions are loose, if that's supporting the domestic economic picture, that is going to benefit small caps, should benefit small caps more relative to large caps. But then here's something else too. A lot of interest rates on debt are linked to what the Fed is doing, okay, with interest rates. So about 33% of the companies in the Russell 2000 index, that's an index of small cap stocks, 33% are financed with floating rate debt. So that means the interest rate on that debt is going to move higher or lower based on what the Fed is doing. That compares to just 6% for companies in the S&P 500. So for large caps, that is why a falling interest rate environment can be such a huge boost to small caps, and you can see it in the numbers here historically. So looking at what various market caps have done when the Fed has started to cut interest rates, this shows what small caps have done over the first 3 months, 6 months, and 12 months out. Same with mid caps, same with large caps. You can see small caps with the best performance across all forward-looking periods. All right, so the Fed's shifting focus toward the risks facing the labor market. Well, that's not the only risk out there as well. The risk of accelerating inflation continues to face investors right here. So we've seen core CPI moving higher over the last 2 months. We talked about how leading indicators of inflation are still pointing to further advances in inflation ahead. And, it's going to really pay to keep an eye on commodities right here, both for a trading opportunity, but as well as the signal that commodities could provide on the inflation backdrop ahead. It's because commodities have a high inflation beta. That means commodities tend to rise and do well when inflation is rising, and rising inflation expectations could happen alongside a breakout in the broad commodity indexes and ETFs. So what this chart shows on here, this white line, this is a equal weight commodities index, and it plots that against the 10-year break-even inflation rate, so long-term inflation expectations. And historically, you can see the two are pretty well correlated. And you tend to see the equal weight commodity basket start to move just slightly before inflation break-evens. And so what you really want to pay attention to right here is that this inflation index is coming right back to the prior high. Look, this is a long-term chart. This goes back to 2011. So this prior high here in 2022, we've come right back up to it. If you see commodities break out right here, that is just going to be more pressure for the inflation outlook ahead. And I believe in the second half of the year, if we do see the labor market stay weaker than what central bankers are comfortable with, but you see inflation you see commodities break out, which is another inflation tailwind, it's going to be a huge headache for central bankers, a huge headache for Powell as they decide, which area of their mandate presents a greater risk, if it's going to be on the inflation side or the labor market. All right, so we have one really big key event I would pay attention to this week, and that is with core PCE. So again, we've already had the PPI, we've already had the CPI come out. Well, several of those components, especially out of the PPI, feeds into this PCE index, and they were running hotter than expected. So you could see some upward pressure on PCE inflation, and the reason we watch this is because the Fed has said that this is their preferred inflation gauge. So keep a close eye on where this PCE comes in relative to estimates, but also relative to the prior month, to see if there's a change in trend in PCE inflation. And then following this, the Friday after this, we should get the next payrolls report. So these are going to be really two key data points, key inputs for the Fed to consider ahead of their next meeting. And so that we could really see, based on where these inflation reports come in and then payrolls after that, it could really influence the odds for a rate cut here in September coming up. All right, one trade idea to keep an eye on this week, and that is with AppLovin, ticker APP. This stock was a huge gainer back last year in September. This started to break out. This was featured in my chart alerts report, Mosaic chart alerts that I send out every week. It's hard to see right here, but we were looking for the breakout right there, just below the $100 level. We got that, and the stock just went on a monster run, right up to the $500 level, peaked out, and now it's creating a new basing structure for us to watch for a breakout opportunity. So the first thing you want to look for is, are we seeing a series of smaller pullbacks? And we're getting that. So you had the peak in February, pullback in April with the rest of the market, rallied, smaller pullback, rallied back toward that 500 level, yet another smaller pullback. So these smaller pullbacks indicate accumulation. It's showing buying pressure and demand for the shares right here. The next thing I want to look for is this bullish MACD reset. So the MACD just measures the distance between a short-term and long-term moving average. What this reset means is that price is just chopping sideways right here. That's a bullish reset and momentum that can support then a breakout over this $500 level. So that's the key level that we need to watch here next week or in the weeks ahead to see if AppLovin can clear this $500 level. If it can, I mean, with the fundamental growth behind this name, the sales growth and earnings growth, that's like rocket fuel for these breakouts. You could see another really nice move higher in AppLovin. All right, that is all for this week. Good luck in the week ahead, and I will catch up with you